After distinguishing between the different products available when trading a single market, the next step is to add a second market to the equation. Traders take opposing positions in markets to reduce risk in their portfolio or speculate on their relative performance. Before diving into the applications, how do traders know if two markets are a good match? Market relationships are gauged by correlation, which assigns a value between -1 and +1. Correlations nearing +1 translate to markets that move together. This calls for buying one market while selling the other. Conversely, negatively correlated markets are traded buy-buy or sell-sell. Opportunity for risk management or pairs trading is considered to be best when correlations are above +0.5 or below -0.5. Take equities for example. The small 75 is a stock market similar to the S&P 500, with a historical correlation that tends to fall between +0.7 and +1. Risk management consists of reducing the size of a position to protect against future drawdowns, also known as a hedge. This is done by trading a market that is highly correlated to an investment in the opposite direction. Investors in the S&P 500 or comparable markets can decrease their exposure without uprooting their long-term position by selling small 75 when they're feeling risk-averse, and then buying back their hedge when they feel the risk has dissipated. Traders should ensure that the risk management position doesn't overtake their initial investment. They can do so by calculating the dollar value of that initial investment and comparing it to the size of the hedging vehicle. For stocks, this calculation is simply the number of shares times the stock price. For futures, it's the number of contracts times the futures price times the multiplier. Small exchange products are easy to adopt as risk management tools given their modest size, efficient capital usage, and simple structure. Since all smalls products have a value of $100 times the price, traders can easily find how many contracts they need to hedge a given percentage of their investment. For example, to hedge 20% of a $100,000 investment with a smalls product that's at $50, traders would need 4 contracts. Pairs trading is a similar process to managing risk, but with a different end goal. It consists of equivalently sized positions in two markets that play their difference in a more speculative manner. Using the equities example again, the high but imperfect correlation between the S&P 500 and the small 75 provides potential when one performs better or worse than the other. The difference becomes its own market known as the spread, that is considered a unique trade relative to either of the outrights. This trade can be executed using the smalls SM75 product and S&P 500 futures or ETF shares. Ratios that take into account product value and movement allow for trading micro E-minis /MES, E-minis /ES, and Spider ETF shares, SPY, against SM75 on an equivalent basis. Small 75 is also highly correlated to other markets like the Dow Jones and NASDAQ, which creates several permutations of pairs trades that could pose opportunity. All smalls products offer a similar wealth of pairs trading choices, whether it's the small global oil product against WTI and Brent crude oil, or small US dollar against the euro, renminbi, and yen. There's a lot of potential outside the simple buy or sell, and smalls products offer manageable tools in this greater world of opportunity. The Small Exchange, big ideas about futures.